items today, including introduction about upcoming testnet for dForce's stablecoin and synthetics launch, a walkthrough of the testnet, any key protocol features, governance-related discussions, new protocol pool setup, risk parameter protocol, and also our new upcoming tokenomics. So we've got a lot of agenda we'll be covering. It should be very exciting. But prior to that, let's first have a introduction of all of our guests. Let's go with Mindao, Mabel, and Panchao in that order. Let's start with Mindao here. Mindao, do you want to introduce yourself quickly?
Yeah, hi everyone. This is Min Dao. I think I would do my introduction, a brief, and maybe Mabel and Panchao can actually have more introduction about themselves. I'm a founder of dForce. Actually, I've been in crypto for quite a while, and we founded dForce around second half of 2019. And I think that Panchao is also, a very early user of a protocol at the time. And I welcome both of Panchao and Mabel to join the call here today. So it's not like this is a call that we also try to engage with the community on the dForce governance, because going forward, we have a lot of product offerings and protocol offerings, and also there is a lot of governance issues that we need to discuss, and it's a very good way that we can have a public forum that we can engage with the key token holders and community members that we can discuss about these issues. Yeah. So I will hand over the mic to Mabel and Panchao. Yeah.
Hi everyone, this is Mabel from Multicoin Capital. Thanks Linda for inviting me today to join this live stream. Very excited to discuss synthetic assets and everything else with you two here. Multicoin Capital is a crypto investment firm based in Austin, Texas. We manage across both the liquid fund as well as the venture fund. We currently have about 11 people total in the company, and then myself and another investment team members actually in China, versus all the other ones are in Austin and New York. Yeah, and then we invested in dForce last year at the beginning of the year, and then we are very excited continuously backing dForce and be supportive.
So Michael, is almost an anniversary, right? And 1 year, exact 1 year, around that. I think we closed the deal like April. Yeah.
We only announced it around that time. It was slightly earlier. Mm.
Yeah, and actually for the audience, I mean, particularly for the Chinese sort of crypto entrepreneurs, I think Multicoin is definitely go-to shop for you, the top go-to shop for you to find fundings. And Mabel is full-time in China, so I think it's very easy to locate her if you have any good crypto or DeFi ideas. Yeah.
Thank you.
Okay.
All right, then shall we have Panchao introduce?
Sure. This is Chao from Maker Foundation. Myself being a evangelist for classical DeFi for several years in the Chinese community, and I'm very familiar with the dForce protocol and happy to help and contribute with the governance and the economic design. Thanks for the invite.
Yeah, Panchao is indeed the OG of DeFi in China. I think they started. I think Maker community is one of the strongest and most solid DeFi community that we actually participated very early on. I think Panchao is leading the whole community development of Maker, and actually I think that most of the Maker users, the DAI users, basically are BD by Panchao. I think probably 95% of them. Yeah. Welcome on board.
Yeah, welcome everyone, and thanks for the great intro. So the format of the call today would be as follows. For the first 35 minutes, Mindao, Mabel, and Panchao will be going through the agenda items in a fireside chat format, followed by 20 minutes of Q&A, from our community. So I'd like to encourage Maple and Panchao to ask questions and make comments during the presentation that Minda would be going through, and really kind of treat it like a fireside chat or like a talk show. And all community members are welcome to ask any questions to dForce or any one of the guests at during the time of the call. Just write them in any social media outlets of ours or directly in the comments section of the live streams. We'll be compiling them and we'll be addressing them for 20 minutes at the end of this call. All right, so let's get right started. Mindao, do you have the presentation ready to go? All right, cool.
Okay, I can share the screens here. So basically, I think as Eve just said, that we will go through some of the items, and I think this community core is particularly important because we actually are launching our synthetic and stablecoin protocol along with our lending protocol. Actually, our lending protocol has been on mainnet for a while on Ethereum and Binance Smart Chain. But I think this combo launch is basically going to complete our full DeFi stacks covering assets, trading and lending, particularly on the asset and lending side. And I think I can now actually share some of the testnet interactions with you guys. So here is the, can you guys see the screen? Yeah.
Yep.
Okay. So finally, the dark mode coming to our protocol. We used to be like using a light mode, but you guys can switch, whichever mode you want. I actually prefer more like a dark mode. And I think on the protocol side, I think that this launch will basically integrated most of our protocols across the matrix, including you guys can see here on the market. We have all the market data here on the dashboard. This is a testnet, by the way. This is the Carbon testnet, and we'll be opening up this testnet to the community on 28th. And you can see that it will be classified in assets, synthetics, and stocks. And on the left-hand side of the bar, you can see lending. So basically for the lending features, this is our general lending protocol. I think that you guys probably are using it today. So it's all the assets that we supported on the lending protocol and the interactions itself. We will be going through that. You can borrow, you can deposit different mainnet assets. And these are the key sort of assets we're supporting today. And then I think the new features that we have here is the synthetic protocol. Basically, we propose to have like 3 pools for that. One is the general pool. So the general pool is actually shared with the lending protocol, right? So whatever you deposit into the lending, simultaneously it will be on the lending pool. So all the collaterals that we supported on the lending side will be actually supported on the general pool. And you can see on the right hand side, the things markets. So these are the core synthetic assets we supported by using the collaterals on the lending pool and including USX, which is a over collateralized US dollar stablecoin, EUX, and XBDC. XBDC is actually a synthetic BDC and synthetic ETH, right? So it's very simple. I already have some of the test token here supply into that. So for example, you want USX. I already enabled it. Let me check on euro dollar. Oh, I all enabled it already. So it's very simple. You click on that, you enable it, and then you can just mint like, whichever synthetics that you want. Yeah, I think Carbon testnet should be quite fast. So basically, the reason we only put like 4 core assets here, I think we can discuss about the pool setup and risk parameters is because this is actually connecting to a lending protocol, but we don't enable them as collateral in this. I think it's already successful. Yeah. So we already mint USX, and you can see the mintage fee here, right? So this is you can look at like a interest rate. So basically minting our stable coins or synthetic assets in the general pool, we probably would like to have an interest rate because we want to encourage people to actually using more on different pools to mint synthetic assets. On the general pool, for example, if you use stablecoin as collateral, you can mint USX and also the other core assets at negative interest rate. For example, if actually you have a GoX, which is like the supply yield now is 16%, you use that to mint USX and all the synthetic assets, you will be able to have a negative interest rate loans. And also, you know, if you're using, for example, USD, BUSD, USDC, and all the other stable coins, I think that, you know, have a very high supply yield now to mint USDX or the other synthetic assets. Basically, it's a negative interest rate loan. It's even better than liquidity, right? So which is a very popular algo stablecoin now. They actually use they claim to have a zero interest rate loans. I think that we can do a lot of interesting things. And you go to the second pool, the synthetic pools. So basically on synthetic pools, you can use all the synthetic assets plus DF token as ingredients, and also of course the LP tokens. So we basically encourage people to use a DF token as a, not just a staking token. It becomes a staking token as well as the ingredients for you to mint all the synthetic assets on the right-hand side. And these are also the core synthetic assets. And difference of these comparing with the general pool is the collateral is different. We only use predominantly our synthetic assets as ingredients. And also, if you notice that the mintage fee here is all zero, right? So we encourage people to go to synthetic pools to mint synthetic assets, and they have a different interest rate model or interest rate curve comparing with a general pool. And also we can use the total supply and mintage cap to basically control the flow of capital through different pools. And now we go to the third one is the stock. It's mainly the equity. We have a separate pool for the stock offering. For example, like if you want to be minting these stocks, this is a proposed stock. It's probably not the final one that we go on launch. So you can actually use USX, EUX as the collateral. And the reason why we don't support a wide range of collateral is because I think stock is a little bit different comparing with the other crypto asset is they have a market close period where you cannot trade the stocks, right? But we can actually, we will be providing liquidity in the AMMs. So people can trade stocks, but you cannot actually mint stocks during the market close. So that's why we use stablecoin as collateral, because during market close, if actually the collateral itself is volatile, it will be quite dangerous because when that the collateral actually swings, your position could be in a position that could get liquidated. But it's during the market close, we cannot liquidate any position. So that's why we only accepted stablecoin. I think that is stablecoin collateral as the ingredients. For example, Tesla is very easy as well. I already have my collateral supply here. So I already have USX and Xcoin is a Coinbase stocks as supply. You can mint like 10 Tesla. It's very simple, and all the price here you can see the Tesla price. So it will be using a collateral ratio to determine how much of the how much Tesla you can actually mint it. So I think it's already done. And yeah, okay, I think it's already done. So I already minted Tesla stocks, and you can also burn it, right? Burn is basically the other way around. You burn it and then you just redeem your stocks that you minted. And after you actually mint Tesla, you can go to dForce Trade here. So we haven't integrated the trade into this interface yet, but essentially it's very simple. We will be providing, we encourage the community to provide liquidity on AMMs like Uniswap, maybe V3 or Kyber DMM. And you can just, our dForce Trade will integrate these AMMs, and then you can just trade that. I already have this, I created a Tesla pools on Uniswap testnet. So we actually, for example, you can, I just mean like two Teslas, you can just swap to USX. It's very simple. So, and this, in this trading markets, it's basically 24/7, right? So there's no stop. So even during the Tesla market close, you can still trade Tesla stocks on Uniswap or Kyber and all these AMMs. And in addition to that, we also talking to a number of other derivative trading platforms, including MCDEX. I already created a MCDEX perpetual market here using USX as collateral, right? So it's very sexy. You can actually use, I already made USX here. I can deposit into MCDEX. And then you can trade BTC perpetuals in the format of like 10 times or even more than 10 times of leverage. Let me just okay, approve it. It's also very straightforward. And we are also in discussion with a number of other derivative platforms so that they can accept it USX as collateral. So you can basically trade BTC and also not just BTC, ETH, even the Tesla perpetuals as well. So it's I think it's a great extension of the synthetic stablecoins into other platforms. And in the meantime, we're also in discussion with the other, lending platforms, so they can use that to also, I think already deposited. Yeah, you can see here, 49 grand of USX already been deposited into MCDEX. So you can now buy long BTC with different leverages that you, whatever leverage you wanna bid at. So it's very straightforward. I think Mabel also invested in MCDEX, right? Multicoin.
Yeah, we did. I actually
Great
let
bet.
that in.
Yeah. I think they are about to launch their I think the V3 on Arbitrum. So we are also looking to.
They are going to launch on Arbitrum, BSC, and Heckle. I think I like the permissionless pool creation. And also the fact that other people can also share your pool, or they can create their own pool. So I think that's a very interesting approach. I actually have a few comments or questions back to the synthetic assets. So like you and I actually previously, I asked you the question about like, why do you think FX on chain is important? I thought your answer was quite interesting. At that point, I was thinking, if the liquidity is on chain, it's most likely that people are going to use US dollar stablecoin. But your answer about like why the the euro or some other stable coins is also needed. I thought it was actually quite inspiring. So maybe you can share with the community about your thought on that part.
Yeah, I think if you look at the trading volume of Europe stablecoins in the market, I think we have one or two. One is from EURS, and the other one is SEUR, which from Synthetics. So I think that for I'm not saying that for the foreign currency stablecoins, it's going to be like 100 or 200 of them, but I think it's definitely going to be a lot of them. At least I think that like 5 to 10 major, foreign currency denominated stablecoins. And the reason for that is because DeFi used to be in crypto only, right? So that's why we see that US dollar stablecoin become a dominant form of stablecoin in the markets. But actually, as we move out from the main crypto use cases, for example, MakerDAO just do a real world asset financing deals. And dForce is also looking at around 5 to 10 pipeline deals now in the in our pipeline regarding real world financings, and we're providing financing to, for example, like Filecoin miners and also Bitcoin miners and app traders, etc. And some of these positions and loans need to carry out in local currency. The reason for that is it's just make life much easier for these traders and borrowers, because all their expenses and their PPEs are denominated in local currency, so they don't need to actually hedge foreign currency risk. Particularly if those local currency are volatile, I think that it's a very good way for them to actually hedge that, and particularly for the corporates where they basically denominate all the balance sheets and P&Ls in local currency. And it just make lives much easier, and that's also why we see in the foreign exchange markets we see a lot of interest rate swaps and FX swaps is particularly for this kind of usage. And this is a huge market, and the reason we really haven't seen a lot of use cases in this area is because in crypto we mainly engage in crypto, right? So 99% of all the trading volumes and all these activities are happening in crypto. But I'm anticipating there's going to be change, given that the major DeFi players already going to the real world assets. Yeah, so that's a more sort of detailed answer to that.
Yeah, that sounds quite interesting. And then you mentioned the stocks. How the external price feed, like let's say you're trading after market hours, is the aftermarket price also going to be fed there, or how is it done?
Okay, so that's how it works. So for example, if actually we are minting the asset, the stocks, there need to be a oracle that fit the stock price from the markets, right? So we are now using Chainlink or BAN, for example, like for the stock market price feeds. So during the market opening, it's very easy, right? You can mint it. But for the trading, you look at how we actually trade these stocks. It's actually not happening on a platform. So we are not like Synthetics, where they have their sort of built-in trading system against their own protocol. They need to rely on an oracle to function, right? So there is the market close for Synthetics. You basically is not able to trade against the system. But I think that they're opening the balancer pool now, so people can also trade some of the synthetic assets on Synthetics. But for the for us, you can still trade the stocks aftermarket, and I think that's the fantastic thing about crypto and DeFi is because it's all permissionless. If actually I'm providing liquidity on Uniswap, there is no sort of market close time, right? It's always operational. It's 24/7. And there will be price discovery during those market close time. And but as a system design, you are not able to actually mint stock during the market close, but you can still trade it. So there will be like quite an interesting. If there is, for example, there is a major news that happening on Tesla, you can still bet on that event, trading the stock on Uniswap, right? So when the market closed and we are able to mint Tesla stocks, there will be a lot of interesting arbitrage between our system and the trading markets. So I think that's also something that DeFi actually bring to the markets, because people asking that if I can trade stocks on IB and all these brokers, why would I like to use DeFi, right? But I think it's totally different. We tackle the problem in totally different angle, and I think that crypto stock trading definitely offer a lot of interesting attributes.
Got it. And then the LP pair for the US, no, the XBTC and WBTC and all the other ones, are there going to be yield farming? Like
yes,
with those
I think that we can talk a little bit about the liquidity incentives later on. But the general idea is that we definitely want to encourage people to provide liquidity for the synthetic asset pairs, including you can see some of the pairs here. XETH, ETH, and BTC and WBTC, and also the most important pair is USX versus USD. So actually, we have a very deep pool for this one. It's going to be routed through all USX. So we don't need every, we don't need, this is a major anchor pairs for the USX route. So we can use that to actually route through all these synthetic assets in the system. For example, like USX Tesla, we don't need USDT Tesla. We only need USX Tesla. Then people can route through that. And we'll be encourage people to provide liquidity on these LP tokens. But I think the value for those LP tokens has not been decided. I think that we also would like to hear your feedbacks as well, Maple and Panchao, on which platform that we want to be providing incentive for liquidity, because I just try out Kyber DMM, and also we are working on sort of virtual liquidity AMM at the moment. I think it's much more efficient than the Uniswap V2. So likely, if actually Uniswap managed to launch their V3 on Optimism, we probably could provide liquidity there. And it's definitely much more sort of capital efficient, particularly for these stablecoin pairs, right? These are all stable asset pairs: BTC, ETH, USDX, and USDT. And I tried that on Kyber DMM. I think it's almost like 100 times at least improvement on in terms of capital efficiency. So if actually we have like 10 million US dollar liquidity pool there, the slippage is very, very low. So I think I would think that we probably should provide liquidity incentive for trading on these high performance AMMs, and also for this synthetic asset liquidity provision. I think we also probably will need to tap into Binance Smart Chain, because the ecosystem is growing very fast there, and also that gas is definitely a very compelling narrative for these synthetic assets, and you can just mint there and trade at very low expenses. I think we definitely need to decide which AMM we need to support it more. Yeah. But at the end of the day, we're going to be integrated with the dForce trade. So you can just trade here. And we also try to integrate some of the synthetic derivative platforms directly through this interface. So you can trade like 10x, 5x derivative here as well. So here's yeah.
No, I was just saying, like, I personally think you should apply for Onzen, but I'm curious what Panchao will say.
Onzen, you mean the SushiSwap thing, right? SushiSwap instant.
Oh.
Yeah.
Yeah. First of all, very neat UX, and it looks great. Question: is USDX retired, the old stablecoins?
Well, they still exist because it's different design, total different design, and it's quite interesting, right? I just going through, from one of the most, one of the critics of MakerDAO's design now back into ground zero, and then we come up with the over collateral stablecoin. So because I have a lot of debate with Panchao very early on in Maker community regarding how it's impossible for Maker to make a stablecoin, and I think for USDX is still there because the design is quite different. USDX is actually for more like a high yield pursuit, so people actually are looking for a high yield still can look into that. But I think that the problem with USDX is that it inherently didn't have a built-in sort of demand mechanism, right? So people need to deposit stablecoin on the other side to mint a synthetic stablecoin. It's not like USX where you basically can do leverage and you can just do a more sort of, I think it's more mimic. I think it's more like lending or trading, and you can inherently just leverage with the stablecoin. So we probably will be putting less efforts on USDX going forward, and more towards encouraging people for the USX adoption. And the other reason is that for example, if you actually want to have to trade like Tesla stock, provide liquidity there, you have to own USX, and you have to actually supply collaterals, right, in some forms into our lending protocol. So that's why when we're doing this combo launch, all these will add up, right? So if actually you are providing liquidity for our synthetic assets, you are absolutely 100% a lending protocol user in that sense, because you have to supply collateral here, and all the collateral you supply in the lending protocol would actually help those who want to borrow these assets at lowering their funding costs. So I mean that's why the combo offering is so I think it's so attractive, because all these components they look like separate, but actually it's connected. Yeah.
That makes sense.
So Panchal, do you think that we should retire it or put less effort on USDX, or you believe that there's still a good market there? Because you can see like M stable, right, is using the same mechanism, but it seems like they are still quite struggling to find the use cases for that. Yeah, I
Right.
also want to hear your views on that. Yeah.
There's no. I don't think there's a kind of consensus answer to that question. I think M stable has some similarity to USDX,
Yeah.
but I think they are less capital. They need less capital comparing with USDX. They only need one stablecoin to mint the MUSD. I mean, they don't need to have this composition of different ratios. So I think they all and they are expanding to like BTC and other markets.
Yeah, they recently just launched the BTC as well. Yeah.
And you can also, I think user can also swap between the different reserves. So I think that function is, that their issue is just with the starting period. The asset they were choosing was not in par. It's like because DAI was at premium. So I think that kind of killed some momentum. But I think this model still has some good prospect. And regarding to USDX, I think, I think last time I looked at the current market cap is around a few million. That's because now the protocol put less incentive to the liquidity, so I assume many are kind of redeemed.
I think
the function of USDX is creating a bridge between different stable coins, and that function is still needed. So I don't think it needs to be retired, but it's just how design system to connect those two, create a market from USDX and USX. But the fundamental design may change a little bit with regarding to the asset selection and the compensation. I think, it does. I don't think it required to combine different stablecoin with the same properties. They are all regulated. They are all legal compliant to mint one stablecoin. I think for USDC and the PAX, I would treat them equally, which means that it should be sufficient to mint one from only one stablecoin, if that makes sense.
Yeah, I think you've actually looked at MakerDAO, right? So the PSM module is pretty similar to what we're doing on USDX, right? So you're actually using a stable coins, you can vary 100% collateral ratio, then you can mint the other the DAI. So actually for our current design, we actually is compatible to what we can do with USDX. For example, we can create a pools that specifically for stable coins that they can mint USX or Euro. With 100% collateral ratio. Basically, we can replicate USDX design in this synthetic combo. We can just create a pools. So it will make people very easy to actually using different stable coins at very high capital efficiency to mint our stable coins. And I think there is also one of the pitfalls for the USDX or the M stable design is that the collaterals on the collaterals is highly constrained to stable coins. And the problem with that is basically, you know, for like MakerDAO and us, and now we can actually use all these collaterals that we support in lending protocol. So it's more, I think it's more fungible, right? So for example, if actually use, you have BTC and GoX or the other Uniswap, you want to trade, use that as collateral to trade perpetuals in MCDEX, you can just mint USX and the others and which supported here to just collateralize and trade here. So that's why I think I think USDX design is I think is addressing the different markets, but I think the over collateral stablecoin design is more I would say is more scalable in that sense. We basically can be scalable to accommodate what we can achieve in USDX.
Right. Yeah. I think the design of USDX is more. This is just my personal kind of deduction. I think it's more to create a trading market between, like, the trading windows between the different, provide a window for the different stable coins rather than to create the synthetic asset itself. Which that means is now you have USX can be generated from those stablecoin, but it's more like a collateral. It's like a repurchase agreement. So you deposit DAI with a relatively higher collateral ratio. Let's see, 110 or 102 or something. But that is more for the short-term arbitrage opportunity, maybe, or to access to the instant liquidity. But also you can have a trading window, like the PSM. So you have the 100% capital requirement. So you can generate the USX and exchange it back. So I think those two models can concurrent. So it's just a question for a trading window with the right amount of cap and the fee setting. And also regarding the fee, the mintage fee, it says here is actually the annual rate, not one time cutoff rate.
It's annual. It's similar to stability fee in MakerDAO. So we don't want to make like interest rate, right? So it might be interest rate is a little bit too financial. Just like mintage fees, it's like stability fee is on annual basis,
Yeah, it scared me at the first when I saw you put mintage.
You think it's one off, right?
I thought it's one off.
It's not one off. Yeah. So so it will be interesting because, I mean, if you actually supply stablecoin here, you can earn like 7% interest, right? And then you mint 2% on the other side, just like what MakerDAO's DAI do, right? So you basically are borrowing a negative interest rate leverage loan to actually leverage on your positions. Yeah.
So I'd just like to chip in really quickly here and remind everyone that we only have about 1 or 2 minutes left for this session before we go on to the Q&A.
Oh, really? Okay. So I think that we probably should still go to the slides, right? I will stop the testnet show here, and I probably quickly go through the slides on the I think the roadmap we already discussed in the previous community call. I think I will quickly go through several slides on the comparison and also the pool setup and risk parameters before we go to the Q&A. And here I think that we do a very high level comparison of dForce combo with like Maker, Compound, and Synthetics in different sort of different aspects. For example, like Neighbor stablecoin, now dForce and Synthetics and MakerDAO both support it. And Compound is a general lending protocol, so they don't. And of course, on the multi stablecoin side, Maker only have US dollar and Synthetic and dForce have both US dollar and the other foreign currency denominated one. And so the capital efficiency, I think that we already discussed that on the in an article previously. I think for Maker, they still maintain a pretty high collateral ratio, but it's not as high as Synthetics, but still pretty high. And I think the other one is because Maker is using a CDP model, where we're using a pool model like Compound. So I think that for a pool model, you're able to actually relay your collaterals to the other borrowers. So it's inherently more capital efficient. And also the capital constraint, I think that we are quite expansible because like you can basically support any collaterals, with the right risk parameters. And the other ones, I think that we probably will we provide more comparisons in some of the analysis that we're going to be putting up to the community. And on the pool setups, I already discussed that we have lending, synthetic, and all the stocks. And we're also looking at extending the lending to real world asset financing. We're looking at a number of other deals now at the moment. And it will be a different pools for real world asset financing because most of these loans are actually fixed rate and fixed term loans. So it's not compatible with the pool base. But we try to actually design a fixed rate loan where they can tap into the liquidity of the pools. So these will be, that's why I'm saying that is horizontally scalable, so we can accommodate different financing needs. And here it's just the mechanism that we describe for lending to synthetic assets. And I think that if for the audience who is interested in the mechanism, I think you can go through the media article we put out previously. So for the pool setups on high level risk policy, I think as you guys already noted, right, in the general pool, all the core synthetic assets now is not enabled as collateral in the general pool. So basically, you cannot use USX, EUX as collateral in our lending protocol. I think this is important, particularly for the initial launch. We want to be like more cautious on that to be used as collateral. But I think the community can actually propose when the protocol stabilizes at which time that we can enable it as collateral. And of course, we're going to be doing that, but it's just not at the initial launch. And the synthetic pools only support core synthetic assets and associated LP tokens. I think this is the same kind of risk policy that we take into consider, particularly at the early stage. We want to be segregating the pools. We don't want to be just having the risk that's freely penetrating through different pools. We want to segregate it and just make it more stable until we enable the liquidity flow between these different pools. And the mintage fee for different pools, as we just discussed earlier, we will be applying different ones and see how the incentive goes. And of course, we actually want people to go to synthetic pools to mint using the F token as collateral to mint all these synthetic assets. And it's also a very good way to align the interests of the F token holders with our protocol as well. And all the synthetic stocks are not able to be used as collateral at initial launch, but we're able to enable that as collateral, and so people can actually borrow different stocks using different stocks as collateral. But I think at initial launch, we just be more sort of stringent on this risk policies. And here is some of the high level sort of risk parameter settings for our different pools. We already have this on the forum. So Mabel and Panchao, if you guys have any sort of comment regarding all these risk factors, and we already discussed some of them, but not all of them. You're also welcome to provide your comment as well. But all these are not necessarily be the risk parameters we set at launch. We still need to put up a governance proposal for the F token holder to vote into execution. Yeah.
Yeah, the only suggestion I would give is to change the name change from the mintage fee to mintage fee rate, something like that.
Oh, okay,
It's just
okay, that's a good suggestion. Yeah. So you
it's
think the fee is still a little bit like a little bit misleading, right?
yeah, because it's like a fee on the mintage. It's just
Oh,
yeah,
okay,
it
I get.
makes
Okay,
people feel
yeah,
it's one-time cut.
yeah. I think that's a very good suggestion. Because we don't want to use the interest rate because it's a little bit like it's too much like a loan. Yeah, I think we need to come up with a better sort of name for that. Okay, then I quickly go through the token economics. I think you guys already see the proposals that I think this upgrade will significant change the token economics of our DF token. For example,
So
all DF
Mindao,
tokens.
let me
Yeah,
just quickly kind of interrupt
yeah,
here. We actually
yeah.
have a question from the community asking about the tokenomics. So
Oh,
perhaps,
okay.
it's better you address this during, while answering that
Sure,
question.
sure,
And just,
sure,
yeah,
sure. Yeah, yeah.
cool.
Do you have the question now? You want to read it or?
Um, no, so I was suggesting that you could maybe skip these slides and go to the next slides and then just wrap up this session so we can move along to Q&A,
Okay,
and then you
okay,
can
sure,
answer it
sure.
during Q&A.
Yeah, okay, sure. Just I think that we could quickly go through that within like 1 or 2 minutes. I think DF token is going to be a staking token within the whole ecosystem. So people actually can stake that into our VDF and then can participate in governance. And we also have the fee accrues across protocols that we will be using to purchase DF and redistribute it to BDF token holders. And there's one addition to that is we basically, our lending protocol and synthetic protocol was supporting direct DF stakings. So basically you can use that collateral, you can deposit your DF and then it will be directly deposited into the staking contracts. So you can use that as collateral at the same time you can earn staking yields. So that's something that we also try to implement. And value capture, I think, is very straightforward. That we try to capture the value across lending, trading, and assets, but in different ways. One is through interest rate reserve, the other one are through the fees. So going forward, that we will be accruing more value towards the DF token holders through these mechanisms. Yeah, I think for these are more detailed sort of risk parameter setups. I think that we can go through the forum post. And on the governance, I think that I spent probably 1 or 2 minutes on this. We actually will be implementing the governance, the new governance system probably around June. And the new governance will allow the DF token holders to delegate their votes to the community members. For example, like if you believe that Punchao is a very good governor for dForce, and then everyone can delegate your DF token to Punchao, then he can vote on behalf of the DF token holders on all these governance issues. And we'll be opening, to invite all the DeFi experts in the space to actually participate in this. And we also encourage all the DF token holders to actually delegate to the experts that can engage in governance discussion. And of course, for us to actually migrate to a fully on-chain and 100% sort of decentralized governance, they'll take time, particularly for some of the protocols that we need to wait until they stabilize and matured enough to be able to do that. And on liquidity mining initiative, we actually will be sunsetting our existing liquidity mining on our U markets, as well as some of the asset protocols. And we'll be replacing with a new one that center around USX and synthetic asset liquidity bootstrapping. And also we have a built-in yield farming in the lending protocol as well. But I think for the detailed plans, we'll be submitted that to the community for the comments and feedbacks over the next 1 or 2 weeks, and then we will also submit that for voting as well. So I think the idea is that we will be looking at liquidity mining from more of a combo protocol perspective instead of a standalone ones. Yeah, so I think this is wrap up my presentation, and yeah, so if we can probably go to the Q&A.
Yeah, but right, the community has sent in quite a few questions, so we should try to address as many of them as possible. Some contents we briefly covered today will be elaborated in detail at a later date, so encourage our community to stay up to date through our social media channels. So thank you very much, Mabel, Panchao, and Mindao for the brilliant discussions and opinions. I hope everyone enjoyed the discussions. I've compiled a list of questions that came from our community, so let me just address one by one for the next 15 to 20 minutes. So the first question goes to Mabel. So Mabel is engaged in other DeFi governances, and what is some of the best practice in DeFi governance, and is there anything to be avoided?
This is actually an interesting questions because I'm a multi-sig in one of the major trading platform. I do think there is a lot of advantages in terms of like having a decentralized governance DAO, a group of multi-sig rather operating instead of like having a more like company type of structure in terms of coming up with new ideas, because obviously you all have a lot more sources of idea, but then at the same time you realize the efficiency in terms of executing things is going to be like slower. And then often the time there's no a central mind in that protocol to really decide like what is the roadmap. Basically there's like no roadmap, similar kind of to Decred, DCR, like they also don't have a roadmap, but it's all voted by the treasury. I think, I mean, generally speaking, you'd be surprised by a lot of these very active community, like, Curve, like Sushi, YFI, like how many new proposals they can come up with. Even outside of DeFi, right? Like Helium, like they also have a lot of, interesting proposals in the community. But then I think the key problem lies at the, like, who to decide which one to be voted through first, and then what is the execution priority. I'd say, even like, teams like Sushi, they're still struggling with this. Like, for example, they want to get on a bunch of new public chains, but then, or like, EVM compatible chains like at BSC. They want to do a lot of them, but apparently they can't do many of them at the same time. So then, like, who is the person to really decide like which one is to, and then it will take some time to discuss and vote or whatever. But overall, I think, as long as you have a very, very active community and then coming up with a lot of ideas, this is like generally going on the right direction. But it is a matter of like whether you want to prioritize efficiency or you want to prioritize the collective with like, what do you call it? The collective witness. In that sense, I am actually, more towards the community governance. I think like how you can improve the efficiency of the execution and also discussing the proposal, it takes time, but it will become better. So I don't know whether that answers the questions, but yeah.
Yes, that's definitely helpful. I think it's really helpful when you're providing these very multifaceted answer to the questions. So thank you for that. And the second question goes to Panchao. The community is asking, Maker has done real world asset financing deals. And could you talk about this experience, any obstacles and how you resolve them?
Yeah, particularly because we also doing our real estate.
Was the last part of the question?
It's the obstacles and how you resolve them.
Oh, okay. Sure. I can't speak for the. I can only speak for the foundation. I can't speak for the DAO. The real world asset initiative was fully initiated and operated since made it successful by the DAO. So it's all the achievement and result from the committee, and that actually linked to the question to the last question regarding the governance. So I think that just show how how is successful governance look like, and I think that also linked to the personally, I think it's just show some property of the feature of the governance. It need when you need some implicit and local knowledge regarding the real world asset, because it's all it's majorly offline and need some local expert to actually execute it and connect with the local business. And also it need when, and also governance when it has a kind of cross-border compliance issues, you need governance kind of to mitigate the risk to the minimum. So I think that that's how the DeFi governance can play out is benefit in those situations. And I think real world asset is a good showcase of it.
I see. Very interesting. So this next question we have for Mindao. So we have a few questions for Mindao, and we have another one or two questions for Panchao and Mabel. Let's ask a question to Mindao actually. So how will the new tokenomics capture value for DF? So I think to answer this, Mindao, I think you could go back to some of the slides that you had and just go through the tokenomics and like walking the community through the value capture.
Okay. Yeah, I think that we actually looked through the slides. Only two slides there. One is the yeah. So I think this one is for the yeah. So for the ecosystem, because I mean dForce, we actually have a lot of protocols, right? So it's spanned through the lending, assets, stablecoin, and trading and yield market as well. So we're trying to create it integrated. So it actually make it quite difficult to have a token where all the economic interests are spread across different protocols. So I think the VDF sort of staking model that we propose is basically try to unite all these economic interests or value and fee accrue across different protocols. So basically, there's we want to create only one entry points, right? Only one interaction with the ecosystem is through the VDF staking contracts, where you stake there, and then you can have the benefit of all the systematic staking use, as well as the fee accrues towards that. And of course, if actually you're providing liquidity, into different synthetic assets, and you will be having additional DApp token distribution with regard to that as well. So if actually you look at this value capture diagram, we are designing it so that the interaction for the DF token holder is very simple. You just stake that into the VDF contracts, and you will receive the systematic staking yields. We haven't set the level of the staking yields. So regarding staking yield, it's very similar to the POS sort of staking yield. So you will be having a fixed yield, but it's actually depending on the staking ratio of the whole ecosystem. If actually more people stake into the contract, probably the less the yield, and then if less people, there will be more the yields. These are systematic, and also we have like the other fee accrues and fee burns through all these different protocols. And for example, like lending, right? You have interest rate reserve. We have currently we have a reserve ratio to capture the interest rate sort of earns from the lending protocol. I think that the same will apply to the synthetic protocol. You have interest spreads of minting synthetic assets using different pools. So these will be pulled together, and then it will periodically purchase DF tokens and then redistribute it to the VDF holders, or it just directly burn, where it will benefit all the DF token holders. So I think that we need to iron out a lot of details because I mean for this VDF implementation, it will still take some time. We're working on a smart contract now, and we basically want to make it that people can actually freely stake their tokens. At the same time, they still have the benefit of using that as collateral to actually mint different synthetic assets. So we don't want to restrict the DF token holders' freedom to actually use that as collateral to do different things. So the current design is that we actually try to maximize the freedom for the DF token holders, at the same time allowing them to earn more upside yields. Yeah. So
Great. Yeah. I mean, so yes, so regarding tokenomics and our kind of value capture model, we will definitely be posting out more articles and information to our social media channels, so our community can definitely keep their tabs on those. For timing purposes,
I think there's a lot of interesting discussion around that in the community. For example, like people prefer burn model, where in our current design, we actually not really focus a lot on burn model, right? We actually use the repurchase model and then redistribute to the app token holders. I think there's a lot of pros and cons of different models. People like burn model is look more like, it seems like more logical, and I think that we definitely encourage the community to have more discussion around that. And of course, if actually people prefer burn model, we can implement that as well, because currently in the USDX synthetic stablecoin, we already have a burn mechanism built into that. But I think the burn model and the redistributed purchase and redistribute model, it works in very different in terms of the economic incentives, because the burn model basically benefit all the passive DF token holders as well. So it basically burn the whole outstanding. It burned through the circulating tokens. So it will benefit all the passive and active token holders. But a VDF staking contract will basically encourage more DF token holder to be more active, right? So you have to stake into the contract, and you have to use that as collateral. You have to use that to mint synthetic assets. It's more like to encourage people to be more actively engaged in the community. Yeah.
Definitely. So, I mean, perhaps this can be a further topic that we can discuss for the next community call. And for timing purposes, I think this would be the last question we'll address. The questions for Panchao regarding stablecoins. So what's the best stablecoin design in the market, in your opinion? We see a lot of algorithmic stablecoins in the market. But there could be different issues such as liquidity or etc. So could you provide some insights on this topic?
I think everyone knows the answer to the questions. The best stablecoin design is DAI so far, at least from my personal opinion. And the second best, I think, is Tether, surprisingly. And then the third, maybe USDC, but USDC is less creativity, but more like compliance strength. So I think those three are at least the serious stablecoin in the market. They are borrowing the wisdom from the traditional finance. The DAI is the bridge from the traditional world to the crypto world. USDT without further intro, we all know how they operate their capital efficiently. So those three are the ones also prevailing in the market. With regarding the Argo stablecoin, I think it's fun. I mean, but it has some risk and consequences. So I think people need to aware of the consequences and who are they betting with against.
I see. Yeah, that's great insight. And yes, I agree with you on the rankings too. So, well, That is all the time we have for our community call today. We're actually slightly over time, but we're doing pretty well. Thank you again, Mabel, Panchao, and Mindell for your insights today. It was a pleasure to have you with us. And on behalf of the dForce team and the guests, I'd also like to thank our community for joining us today for the call. We'll be posting a highlight wrap-up on all of our social media channels in the next few days, so you can review any materials you'd like to go over again. And the live stream was recorded, so it'll be posted on our YouTube for our community to watch again if they'd like. So
Eve, I think probably still compiling some of the unanswered questions for the community. I see there are a lot of questions coming out. So we probably should compile it and then provide a written sort of answer to that later on the forum, etc. Yeah.
Yes. So we've actually compiled the rest of the questions. There's actually quite a few outstanding. We can answer them during the call, due to time constraints, but we would like to let the community know that we'll try to get to these answers to these questions and in a written format through our Medium or Twitter or our social media channels. So definitely stay put for those. And this concludes dForce's community call today for April 26th, 2021. Thank you all for attending, and we hope you've enjoyed the call.
Okay, thank you, Mabel. And
Thank you, everyone.
Thank you, everyone.
Bye-bye.
Bye-bye.